Everyone wants to know how they grow their money quickly while putting in as little effort as possible, because work smarter, not harder, right? That's what I'm all about, and I want to help you do that too. Because we have high interest rates in the US right now, we have some unique opportunities to passively grow money more effectively and easily than ever. In this video, I'm going to be talking about high-yield savings accounts and CDs. Hey, I'm Lorianne, I'm co-founder of Dow Janes and a money coach, and today I'm going to talk about the two places you can put your money that will allow it to grow without you having to lift your little finger, especially taking advantage of the interest rates that we're seeing right now. But first, if you want more tips on how to grow and make the most of your money, be sure to subscribe and hit the notification bell so you don't miss out on our future videos. We put one out every single week. High-yield savings accounts are a type of savings account offered by banks or financial institutions that typically offer a higher interest rate when compared to just traditional savings accounts. These accounts are designed to help you grow your savings faster by earning you a higher rate of return on the money that you hold in the account. So, same amount of work, just putting money into a savings account, but now you're going to get a higher rate of return. We'll talk about some of those rates in just a moment. Another great thing about high-yield savings accounts is that they keep your money really easily accessible. So if you have a chunk of money that you want to sit somewhere where it can get fairly easy and high interest rates, so for example, holding your emergency fund, money that you want to have it be very liquid, very easy to access in case of an emergency, you don't want to tie it up, a high-yield savings account can be a great fit to hold money like that, and it lets you still earn competitive interest rates. These types of high-yield savings accounts are typically offered by online-focused banks and credit unions. Here's a few things to consider when picking a high-yield savings account. The first is your APY, aka the interest rate. This stands for annual percentage yield, and it's the interest rate that your money is going to earn while it's in this account. This number determines how quickly your money will grow. The higher the number this is, the better. Second thing to consider are monthly fees. Any fees you have to pay on the account is going to eat into your savings and the interest returns that you're getting. And so there are plenty of great high-yield savings accounts that don't have any fees associated with them or any ongoing monthly fees. So try to find an account with zero fees. The lower this number is, the better. The third are withdrawal or transfer fees and limits. So some accounts will charge fees for transferring money in and out of the account, or they may only allow you a certain number of withdrawals or deposits per statement cycle. Now, this isn't necessarily a bad thing depending on how you're planning on using the account. After all, the primary goal is to leave your money alone and let it sit there and grow, but it is something to pay attention to when you're considering your options. Make sure you understand how the fees of the account work and select an account that matches up on how you plan on using it so that you're able to keep these fees as low as possible. The fourth thing to consider is a minimum deposit or balance. Some banks will require you to deposit a certain amount when you open the savings account, or will require you to maintain a certain minimum balance. And if you fall below that number, they may charge you fees. So choose an account with a minimum balance that is something that you can maintain. When you're selecting your high-yield savings account, it's important to note that the interest rate, the APY that the savings account offers, can change at any time. These rates are variable, and they often go up and down in accordance with how the Federal Reserve changes its benchmark interest rate. So right now, at the time of recording this video, it's a really great time to put your money into a high-yield savings account. Because interest rates have been going up to fight inflation, we're seeing some of the highest interest rates we have seen in decades. But these rates will likely continue to change, right? So paying attention, when you get your monthly statement, look at the interest rate that you're actually earning and make sure your money is still in the best place. For context, right now, the average national rate for a traditional savings account is 0.58%, but a high-yield savings account can earn you up to 10 times that rate. We're seeing interest rates over 5% in a high-yield savings account. So I strongly encourage you to check one out. All right, the second way to easily grow your money passively right now are through CDs, or certificates of deposit. This is another type of savings account. Like a high-yield savings account, CDs tend to have a much higher interest rate than a traditional savings account. There's a few important differences between CDs and high-yield savings accounts that are important to understand. The first, CDs are less liquid than high-yield savings accounts, meaning there are limits to how and when you can access your money. Unlike a high-yield savings account, when you put your money into a CD, you're agreeing to not withdraw it for a specific period of time. And you get to choose this period of time. This could range from a few months to years. But if you do withdraw your money early, you'll have to pay a penalty fee to the bank. So make sure you pay attention to the timeline and the associated fees before tying up your money in a CD. The second major difference is when you put your money into a CD, your interest rate is locked. Unlike a high-yield savings account where that interest rate, that APY, is fluctuating based on the external economic factors, a CD, you are going to hold the same interest rate for the duration of the amount of time you agreed to tie your money up into the CD. So that means if you get a 5-year CD with a 5% interest rate, you're guaranteed that your money will be making that 5% no matter how much interest rates rise or drop over the next 5 years. CDs are considered a low-risk investment and are typically used by people who want to earn a higher interest rate than a regular savings account while still preserving their principal amount and putting their money somewhere that is considered quite safe. Now, if you want to open a CD, here are a few things to consider. First, the length of the CD. The lengths of CDs range from a few months to up to 10 years. And the longer you commit to leaving your money in, the higher the interest rate you are going to earn. But you want to make sure that you won't need to withdraw that money early or you'll face paying high penalty fees. The second thing to consider is the interest rate. This determines how much your money will actually grow while it's invested in the CD. Thanks to the recent interest rate hikes, CDs are currently paying some of their highest interest rates in over 20 years, making them a really attractive choice for investors. Again, the higher this interest rate, the better. The third thing to consider is the early withdrawal penalty. It's good to know going in how much you'll risk paying if you do need to withdraw your money earlier than you agreed to with the length of the CD that you chose. Final thoughts, whatever is happening in the economy, there's always challenges and also always opportunities. If you want to learn the secrets of successfully growing your money passively, be sure to check out our free masterclass. I will leave a link in the description below.